Welcome, traders. What if I told you that most retail traders are looking at the wrong areas on their charts? While they're chasing breakouts and guessing at support and resistance, the smart money, the banks, the institutions, the big players, are leaving footprints all over the market. And today, I'm going to show you exactly how to read those footprints. Welcome to the Order Block Full Masterclass. By the end of this video, you will understand what order blocks are, how to identify them with precision, how to trade them step by step, and most importantly, how to think like the institutions. Let's get into it. Part 1. What is an order block? So, what exactly is an order block? In the simplest terms, an order block is the last opposing candle before a strong, impulsive price move. It's the zone where institutional traders accumulated or distributed their positions before pushing price aggressively in one direction. Think of it as the footprint left by smart money. When a large institution wants to buy a massive amount of Bitcoin or gold, they can't just place one giant market order without moving the price against themselves. Instead, they distribute their buying across a price range, often disguised as a brief counter-trend move, and then use their remaining order flow to push price sharply higher. So here's the key definition you need to remember. Bullish order block equals the last bearish, down, candle before a strong upward move. Bearish order block equals the last bullish, up, candle before a strong downward move. Let me show you what this looks like on a chart. Part 2. Bullish versus bearish order blocks. Here's a bullish order block. Notice this down candle right here, and immediately after it, we get a strong, impulsive move to the upside. That down candle, right before the big green move, is your bullish order block. It represents where institutions were accumulating buy orders. Now here's a bearish order block. See this up candle? Right after it, price plummets downward. That up candle before the big red move is your bearish order block. Institutions were distributing sell orders in that zone. One thing to understand, order blocks are not random. They're a specific type of supply and demand zone. But instead of looking at broad price clusters, we're looking at a specific candle. That precision is what makes them so powerful. Part 3. The 3 confirmations for a valid order block. Here's the part where most traders get it wrong. Not every down candle before an up move is a valid order block. You need 3 confirmations. Let me break them down. Market structure alignment, strong displacement, unmitigated status. Confirmation 1. Market structure alignment. First, you need a break of structure, BOS, or a change of character, CHOCH. BOS confirms trend continuation. CHOCH signals a potential trend reversal. For a bullish order block, you want to see price break structure to the upside after creating that block. For a bearish order block, you want to see price break structure to the downside. Let me say this clearly. If it doesn't break structure, it's not a valid order block. There needs to be a narrative behind it. There needs to be logic. Confirmation 2. Strong displacement. Second, there needs to be strong displacement. A sharp, impulsive move away from the order block. We're not looking for small, weak moves. We want aggressive, directional price action. Multiple strong candles in the same direction. Confirmation 3. Unmitigated status. Third, the order block must be unmitigated. That means price hasn't already returned to and reacted from this zone. If price has already tested it, it's been mitigated, and its edge is gone. Part 4. How to identify order blocks, step by step. Now let's get practical. Here's my step-by-step process for identifying valid order blocks. Step 1. Identify the strong, impulsive move. First, find a sharp, impulsive move on your chart. We're looking for at least 2 to 3 strong candles in the same direction. This could be a big green rally or a big red drop. Step 2. Look for the sweep of liquidity. Before a valid order block forms, smart money often sweeps liquidity. For a bearish order block, you want to see a sweep of a high. Price takes out previous highs, triggering stop losses. For a bullish order block, you want to see a sweep of sell-side liquidity. Price takes out previous lows. Step 3. Mark the last opposing candle. Now, look at the move that swept that liquidity. Find the last candle that moves against the direction of the impulsive move. That candle is your order block. For a bullish order block, it's the last down candle before the big up move. For a bearish order block, it's the last up candle before the big down move. Step 4. Refine the zone. Host. Now here's where precision matters. How do I know exactly where to place my entry? If the wick is longer than the body, use the body. If the body is longer than the wick, use the wick. This is a rule many traders don't know. For high probability order blocks with large candle bodies and small wicks, I prefer to use the opening price of the candle. For order blocks with small bodies and large wicks, I use the wick to the opening price. Part 5. The 9 types of order blocks. Many traders don't realize this, but there are actually 9 types of order blocks in the ICT framework. Let me quickly run through them so you understand the full picture. Bullish order block, bearish order block, bullish breaker, bearish breaker, additional variations. We've covered the basic bullish and bearish order blocks, but let me explain breakers because they're incredibly powerful. Bullish breaker. A bullish breaker forms when price creates a lower low first, that's a stop hunt, taking out stops on the lows, and then creates a higher high, which signals strength. Once you identify this, you mark the breaker block, wait for price to retest it, and enter long. Bearish breaker. A bearish breaker is the opposite. Price takes out a higher high, a stop run, and then creates a lower low, signaling weakness. You mark the breaker block, wait for price to retest, and enter short. Part 6. The trading strategy. Entry, stop loss, take profit. Now let's get to what you actually came for, how to trade these zones. Step 1. Read the trend. Before anything else, know your trend. If the trend is bullish, only look for long setups. If it's bearish, only look for short setups. Never trade against the trend. Step 2. Wait for the structure event. Wait for a break of structure, BOS, or change of character, CHOCH, to confirm the direction. Don't enter on the BOS or CHOCH candle itself. You need to wait for the pullback. Step 3. Wait for price to return to the order block zone. After BOS or CHOCH fires, the order block zone is drawn. Now you wait for price to pull back into that zone. This is your entry window. Entry methods. There are 2 main ways to enter. Limit order equals place your order at the beginning of the order block zone. Confirmation candle equals wait for a reaction candle that confirms the zone is holding. The limit order method is more aggressive. The confirmation candle method is more conservative. Choose based on your risk tolerance. Stop loss placement. For buy trades, place your stop loss below the bullish order block. For sell trades, place your stop loss above the bearish order block. Many traders also add a small ATR-based buffer beyond the block for extra protection. Take profit targets. Your take profit should be at the next structure level, the next swing high for long trades, or the next swing low for short trades. Aim for a minimum 1 to 2 risk to reward ratio. Part 7. Order block versus FVG. What's the difference? A question I get all the time. What's the difference between an order block and a fair value gap, or FVG? An FVG is a price imbalance created when a candle's body completely gaps past the previous candle's range, leaving an unfilled area. A bullish FVG acts as support. A bearish FVG acts as resistance. Order blocks and FVGs are related but different. Often you'll see an FVG form right after an order block. The order block is the institutional accumulation zone. The FVG is the imbalance created when they push price away from that zone. Many high-probability setups combine both. An order block that aligns with an FVG creates a powerful confluence zone. Part 8. Complete worked example. Let me walk you through a complete example from start to finish. Here we have a market that's been moving down. First, I check my higher time frame, let's say the 4-hour chart, to confirm the overall bias. Step 1. I identify a sweep of sell-side liquidity. Price takes out a previous low. This is our stop hunt. Step 2. Price breaks structure to the upside. We get our BOS or CHOCH confirmation. Step 3. I mark the last down candle before the big up move. That's my bullish order block. Step 4. I refine the zone. The body is bigger than the wick, so I use the wick as my entry point. Step 5. I wait for price to pull back into the zone. Step 6. Price enters the zone. I enter long with my stop loss below the order block. Step 7. My take profit is at the next swing high. Risk to reward is over 1 to 2. This is the complete framework, every single time. Part 9. Common mistakes to avoid. Now let me save you thousands of dollars by telling you what not to do. Mistake 1. Trading every order block you see. Not every last opposing candle is a valid order block. You need the narrative. You need the structure break. You need the confirmation. Without all three, you're guessing. Mistake 2. Entering on the BOS or CHOCH candle. Don't enter on the BOS or CHOCH candle itself. Wait for the pullback to the order block zone. Patience is everything in this strategy. Mistake 3. Fighting the trend. If the higher time frame trend is bearish, don't look for longs no matter how good the order block looks. Trade with the trend, not against it. Mistake 4. Ignoring swept zones. If an order block zone has already been tested and price has moved away, it's been mitigated. Don't trade it again. The edge is gone. Mistake 5. Not using higher time frame confirmation. The most reliable order blocks come from higher time frames: 1 hour, 4 hour, daily. Lower time frame order blocks can work, but they're less reliable. Always check the higher time frame first. Part 10. The psychology behind order blocks. Understanding the why is just as important as understanding the how. Order blocks work because of institutional behavior. Large players can't enter or exit positions without moving the market, so they accumulate or distribute quietly, often disguised as counter-trend moves. When retail traders see a small pullback, they might think the trend is reversing and exit their positions. But that pullback is often the institution accumulating more positions before the next push. The order block is where those institutions have unfilled orders. When price returns to that zone, those orders get activated again, creating a strong reaction. This is why order blocks act as high-probability support and resistance zones, not because of some magical indicator, but because there are real, unfilled institutional orders sitting there. Part 11. Multi-time frame analysis. I want to emphasize this. Always use multiple time frames. Higher time frame, 4 hours, daily, equals trend direction and key order blocks. Medium time frame, 1 hour, equals entry confirmation. Lower time frame, 15 minutes, 5 minutes, equals precise entry timing. Start with the higher time frame. Identify the trend. Mark the strongest order blocks. Then drop down to the medium time frame for confirmation. Finally, use the lower time frame for your actual entry. This multi-time frame approach dramatically increases your probability of success. Part 12. Risk management. Even the best order block setup means nothing without proper risk management. Always use a stop loss. Always calculate your position size based on how much you're willing to lose on the trade. Aim for a minimum 1 to 2 risk-to-reward ratio. Some traders use ATR, average true range, to dynamically adjust their stop loss and position size. In volatile markets, widen your stop loss or reduce your position size accordingly. And remember, don't risk more than 1 to 2% of your account on any single trade. Let me summarize everything we covered today. Order block equals last opposing candle before strong impulsive move. Requires 3 confirmations: structure plus displacement plus unmitigated. Mark zone based on wick/body ratio. Enter on limit or confirmation candle. SL below or above block, TP at next structure. Always use multiple time frames. Always manage your risk. Order blocks are one of the most powerful tools in the Smart Money Toolkit. They give you a window into where institutions are actually placing their orders. But like any tool, they require discipline, patience, and proper risk management. Start practicing on higher time frames. Paper trade first. Build your confidence. And once you see these zones jumping off the chart at you, you'll never look at price action the same way again. If you found this masterclass helpful, smash that like button and subscribe for more smart money content. Drop a comment below. What's your biggest challenge with order blocks? I read every comment and I'll answer your questions. Until next time, trade smart, stay disciplined, and remember, the institutions are leaving footprints. Now you know how to read them.